Hello ACCA MOXIE students, my name is Neeraj Sen. I'm your ACCA trainer. I'm gonna start the interest rate risk management. In this chapter, we will understand the how the interest rate affect the how the interest rate impact us, and it will create risk. Okay, so in the previous chapter we understand how the foreign currency fluctuation create risk. Now the due to interest rate fluctuation we are affected and we face the risk. Okay, because due to interest, because increase or decrease in interest risk, our expense will increase if interest rate increase, or if it decrease, our income will decrease. Okay, let's do and understand this. What is the interest rate risk? Sorry, interest rate. What is interest rate? And interest rate is the rate at which borrower pay the interest. Okay, borrower pay interest, and okay, let me choose an rate at which borrower pay interest and investor get return. Okay, so this is the interest rate. So next is the interest rate risk. So how we face the risk? If you are a borrower, then if the interest rate increase, which means you have to pay more interest. Okay, so and if you are an investor, and if the interest rate decrease, it means your return are in return means in return reduced. Okay, which means the your expense is increased and your income is reduced. Okay, let me further explain this. Borrower, if for example today, right now this is now, and for example 3 months after you have to borrow. Okay, you want to borrow after 3 months. You are right now here, but during this time there is a risk that if the interest rate increase, if the rate increase, then you have to pay higher interest, right? If the higher interest means your expense is increased and you will face a risk. Okay, so and in this, the next is the investor. If you are the investor, which means you want to invest after 3 months. You want to invest. Okay, after 3 months you want to invest. You are here right now and you are thinking, what you are worried, why you are worried. You are so worried that what if the interest rate decrease? If the interest rate decrease on the deposit, my income will reduce. But I have to pay. I have fixed commitment. I have to pay my electricity bill. I have to pay my water bill. I have to pay my rent expense. Okay, but if your income as an interest will decrease, then you will face that you cannot meet your expense obligations. This is the risk, and that's why you are worried today, and you are so worried that you want to reduce this risk. How can you reduce this risk? We will do in the next step, or in the after all these slides. In the third slide, I think I will explain how can we reduce this risk. Okay, let's understand gap exposure. The gap exposure, okay, the gap means the degree to which firm is exposed to interest rate risk. Okay, can be identified through gap analysis. Okay, if the grouping means, this can be used, the principle of grouping together assets and liabilities. Okay, and that is affected by interest rate to the maturity dates. Okay, I will explain this, just I'm reading. Okay, The negative gap means, for example, let me explain. For example, you have the liabilities, you have liability that you have a borrowing in your SOFP, statement of financial position. You have a borrowing that will mature. Borrowing will mature after 3 months. I'm taking 3 months just for the understanding. It can be 6 months or 1 year. Okay, borrowing will mature after 3 months. For example, it will mature for $600. Okay, mature for 600. We have liability that is amount $600, and it will mature for after 3 months. Okay, at the same date, we have some assets, means we have investment that will mature after 3 months, but we have only 400 which means we have a negative, which means we have negative dollar, right? Because let's consider this borrowing is an expense, so this means you have negative cash flow. So okay, this means this is a negative exposure, and negative exposure means liability is greater than asset. Okay, at a point in time. Okay, so if the oh sorry, this is 200. Okay, if the liability is greater than the investment, which means if the interest rate increase, your expense will increase, right? Your expense will increase. This is the risk you will face. So this is the degree of risk. This can be measured by this analysis, which means higher the gap, which means this is the gap between investment and borrowing. If, for example, if this is 400, then which means your expense will increase by double, or I can say it means your expense will be higher than this, than currently right now. Okay, so higher the gap, higher the expense, higher the interest rate we have to pay, higher the expense. Okay, so this is the risk, or we can say the degree we can measure this. Okay, next is the positive gap. If for example you have the same example I am taking, borrowing will mature after 3 months. Okay, mature means you will, by the time after 3 months, which means you paid principal plus interest. After 3 months you already paid your obligation, which means you already paid your expenses in case of principal or expense, oh sorry, interest. Okay, after this you have no obligation and you are free. Okay, but on the other side we have assets, which means we have investment that will mature after 3 months, which means we will receive full principal, whatever we invested. For example, we invested 100, so after 3 months, by the time of 3 months, we will already receive our 100 plus 10 as an interest. Okay, after 3 months, or by the time of 3 months. Okay, so we will already received our principal or interest. So right now the borrowing is less. For example, I can say the borrowing is less. I can say 300, and this is 700. Okay, our investment is higher than our borrowing, which means we have a positive cash flow. We have positive cash flow $400. We have a positive cash flow of $400. How can we face the risk if the interest rate decrease? If the interest rate decrease, if the interest rate on investment, if the interest rate on investment will decrease, our income will decrease. Our income will decrease, right? Our income will decrease. So this is the higher the this gap. It means if this for example this is $500, if $500 we have to pay, sorry, we will receive less interest as an income. Our income will decrease. It means higher the gap, higher the gap, reduction in sorry, interest income will reduce, and our income will reduce. Okay, it means higher the gap, our expense will increase as an interest. Okay, our expense will increase as an interest, and here our income will reduce. Right? Okay. The next is interest rate fluctuation. Why interest rate fluctuate, or yield curve. Okay, we will understand the yield curve, and why the investor expect some rate of interest on their deposit, and how their behavior is affected by the duration. Okay, relationship between yield means return and their maturity, which means the timing. How these two variables affect the behavior of the investor, right? Of the investor, how these two variables affect the behavior of the investor, so that their behavior will decide what they decide. Their behavior will decide the interest rate, at which rate they will provide us the borrowing, right? At which rate they will provide us the borrowing. Their behavior will determine this rate. Okay, let's do this. And this is the real yield means yield, or sorry, yield, or I can say this is the yield yield to investor, means yield to investor of, or we can say, for us this is the borrowing rate. Okay, and the timing of the maturity of the borrowing. Let's understand this. So why for example there are three main types of yield curve: the normal, flat, and inverted. Okay, let's understand the normal yield curve. In the normal yield curve, the interest rate will increase with the increase in the time. Okay, if the time will increase, the interest rate will increase. What is the reason? The reason behind is this, that investors can use of funds. So right now they can use this fund. Right now they can use this fund and get more items, which means right now today the value of the currency is higher than in the future. Why? Because of inflation. Because today $1 can buy more items than in the future. Okay, sorry, any currency, like all other currencies can buy today, they can buy more, but in the future it is the risk that they may not get the same item, or we have to pay more dollars to get the same item. Okay, so for the if the time of the maturity, which means if the borrower provide you for the longer duration, longer duration, the fund, they expect that you have to pay higher interest rate because of inflation and the risk, because of inflation and the risk that you may not pay in the if for example if 6 month, if in the 6 month you are sufficient funds, but in the 5 years there is a risk that you may not have the funds and you may not pay your borrowings. So this is the risk. So that's why investor prefer to use the funds right now, and they prefer the liquidity of their funds. Okay, so this is the positive, I can say, the correlation between the time of maturity and interest rate. Okay, and the next is the inverted. Let me explain the inverted. If right now, for example, they are charging very high, for example, right now they are charging very high for just for a short duration, but in the future they will reduce the interest for the longer duration, because for example this is just reduced by the small amount, but this higher these investors are providing investors, or I can say the lenders are providing the interest rate at very high rate. Currently they are providing very high rate, but in the future they are providing at a lower rate for the longer rate and longer duration. But this is the rare case, and I can say this is not the normal situation. The previous one is the normal situation, because higher the duration you will take the loan, higher the interest rate. But in this case the lower. Why? Because the expectation theory. This is the reason for all these. This is the reason for the curve. Why this curve is like this? This is the reason. Expectation theory. In this expectation theory, the investors, the lenders, I can say the lenders are expecting reduction in interest rate, reduction in borrowing, reduction in interest rate, or I can say the amount they invest, they will get lower return, or I can say the borrowing or the loan rate will reduce in the future because of government intervention. So if they are expecting that interest rate will reduce, so they will try to give at the lower rate right now. So okay, because they know that in the future interest rate will be lower, so why not provide them with the lower rate? Because in the future they cannot get this same interest rate that they are getting. So definitely the lower rate will be the borrowing rate in the future, right? So that's why they are lowering their interest rate. Okay, okay, the next is the flat curve. Why the flat curve? What is the meaning of the flat curve? Flat curve means whatever the amount, whatever the Okay, so next is the flat or humped. Humped means this case. Okay, humped means this case. Generally, this is not the ideal situation that the interest rate will be the same for any duration you take the amount and interest rate will be the same. Okay, generally this is humped curve. So why this is humped curve? Because of demand and supply. Because of demand and supply. Okay, if the demand is higher, than the supply, which means the interest rate will go. Okay, interest rate, which means here the demand is greater than supply, so that's why the borrowers are higher than the lenders. Okay, the borrowers are higher than the lenders, which means the demand is higher than the supply. That's why the interest rate will increase. Okay, but in case of for example, in case of if the supply is higher, which means the lenders are more than the borrowers. For example, if the supply is higher than the demand, so the interest rate will reduce. So the lenders will try to provide the interest at a lower rate because they don't have the borrowers, right? So I can say I think you can understand this by the demand of supply, and this is very easy to understand. Okay, so this is the market segmentation theory. Okay, market segmentation theory means demand and supply. Okay, and sometimes it can be the flat, but this is the rare situation. The means when the economy is stable and the demand and supply is equal, but this is the rare case that can be happen in a economy. Okay, so I hope you understand this, and you can see the negative correlation. Okay, okay, you can read this or one time more and you will understand. Okay, so let's do the next we will read this, the liquidity preference theory. And I already told you guys that why the shape is defined by these theories. These are the reason behind the shape of the curve. Okay, these theories are the reason behind the shape of the curve. Okay, so let's read the theory. Liquidity preference theory states that investors prefer instant access of their funds. Longer the funds are borrowing, higher the cost will be. It means normally. Okay, expectation theory means investors interest rate fall in future, then they will be prepared to accept because in future interest rate will reduce, so they are prepared to accept lower interest rate. Okay, short-term interest rate and resulting in inverted yield curve. Okay, market segment interest fact curve. Yield curve not for fact curve. Different segments of investors and sometimes medium, short, medium, and long term. Okay, and this about the yield curve should be based on demand and supply. Based on demand and supply, so humped at the maturity dates when greater demand to borrow. Okay. Next is the methods of managing the interest rate risk. Okay, in this we have two methods. The first one is internal methods, or I can say the traditional, and the another is modern method. This is, I can say, internal methods, or this is also we can say external methods. Okay, so in this traditional methods we have further two methods. First one is matching and the next one is the smoothing. Okay, in matching we match asset and liabilities so that the effect cancel out and we do not face the interest rate risk. Okay, for example, let me explain this. Dollar 400 we invested dollar 400 investment at 10%. Okay, mature after mature after 3 months, mature after 3 months. Okay, and this we have in borrowing, we have borrowing at 10% and mature after 3 months. Okay, if the interest rate, on borrowing, if the interest rate on borrowing will increase, it means our expense will increase. But at the other side, our income, interest rate will increase, also increase, so our income will increase. So okay, so the effect will cancel out. For example, if the interest rate on borrowing increase by 2%, our income will increase by 2%. Okay, so the effect cancel out each other and we don't face any risk. Okay, so because on the one side we are the lender, on the other side we are the investor. Okay, if the interest rate on borrowing increased, which means the borrowing will be expensive, but on the other side we are lender, which means we also lend at higher rate, which means our income will increase. So the net effect is nil. Okay, so this means the where a company match investment and loan of same value. Okay, we match what? We match value, rate and date. Okay, we match what? Value, percentage, rate and date. Okay, percentage, rate and date. We are D. Okay, we match value, rate and date. Okay, what we do, we match all these and then we don't face any risk. Okay, so in this we have to consider that if the assets is of variable, then we have to be create the liability should be the variable. If our assets are of fixed rate, then our liabilities should be of fixed rate. Then only in this case we can mitigate the risk. Okay, mitigate means reduce or managing the risk. Okay, next is this smoothing. In this smoothing, what we will do, we will make a balance between fixed and variable. Okay, so for example, we have fixed and variable. If we have fixed at 60% and if you have variable at 40%, which means and for example the next is another case, we have 50-50 and the another case is 40-60. Okay, if we have higher the fixed rate borrowing, which means we are less exposed to risk due to fluctuation. So which means can I say this is like this, and in this we are like this. Okay, we are like this, but here we have higher variable cost. If the interest rate increase, we are more exposed to this. Okay, we are more exposed to this. Okay, okay, so it is the higher the variable rate, which means higher the risk, okay. So how can we manage this? We can manage this by deciding how much how much fixed and how much variable we should consider, okay, while taking loan, okay, while taking loan, okay. Okay, so moving on to the modern methods of interest rate hedging. The first one is the forward rate agreement, okay, and the next one is interest rate guarantee, and the third is future option, cap, collar, floor, and swap. Okay, so let's start with forward rate agreement. This forward rate agreement is very similar to forward contract in foreign currency. We foreign currency risk management we did in the previous chapter. Okay, so it is very similar and the concept is very similar, and the explanation also kind of similar, but I will explain this again here. Okay, so you can keep in mind, but let's do. Okay, so forward rate agreement. The forward rate agreement means company enters into normal loan but independently organize a forward rate agreement. Okay, so this is the actual transaction. Okay, this is the actual transaction, but this is the forward rate agreement. Okay, both are separate. If you gain here, if you have gain here, you definitely lose here. Okay, so if you have loss here, then you will gain in forward rate agreement. Okay, so its purpose is to hedge risk, not to make profit. Okay, its purpose is to hedge interest rate risk, sorry, not to earn profit. Okay, so if the interest rate is agreed forward rate, a bank pay the difference, if company pay the difference. Okay, I will explain this in when we do the question. Okay, so don't worry too much, guys. I will do one question on this, but this is very important topic in this chapter. Okay, and generally the numerical questions asked. Okay, so we will do that in this lecture. Okay, so let's understand some of the terminology before we go ahead. A 3 to 6 month forward rate agreement, it means it start in 3 months. Okay, start in 3 months and will be last for 3 months. Okay, for 3 months. Okay, 3 months, it will start in 3 months and will be for last for 3 months. Okay, and the which rate, the forward rate, when we go to the bank will quote two rates. Which rate we use the, if we are borrowing, which means bank will charge higher. If we invest in the bank will give lower interest. Okay, so this is the borrowing, this is the deposit rate. Okay, let's do the question. So remember, you always get worse rate. Okay, let's do this question. Patton company in 3 months time, Patton company borrow how much? $2.5 million for 3 months. Okay, from bank, want to has the uncertainty over the borrowing using forward rate agreement. Okay, the quote for 3 to 6 months forward rate agreement is currently, which one is the borrowing? Higher rate is the borrowing, and this is the investing rate. Okay, in 3 months time and 6 months time. Okay, generally this is, it is given here, but in optional questions we have to choose which one we have to select. For example, if here it is given, but sometimes it is like 6 months to 9 months, and 3 to 6 months. So we are borrowing for 3 months. So which means after 3 months, in 3 months time, for 3 months, it means this is the this forward rate we have to choose. Okay, so let me change this. So this is the difference. This is for 3 months, but this is for 6 months. So definitely this should not be our forward rate agreement if we are borrowing for 3 months. Okay, so don't worry too much here, but this can be asked in the exam. Okay, for 1 mark. So show the effect if in 3 months time the spot rate is 3%. Okay, because we are borrowing, so our rate is this. Okay, but spot rate is this. Okay, as our borrowing period will start in 3 months, so and last for 3 months, so we need to select which one, 3 to 6 month forward rate agreement at 2.5. Okay, we will borrow at spot and pay interest. Okay, we borrow at spot and pay interest. How much we pay? We pay this much. Okay, but bank promised us that our rate will be, how much? Our rate will be, okay, actually guys, sorry, this is not 2.3, this is 2.6. okay, this is 2.6. okay, so this is according to FRA, but this is according to spot. So we will borrow at spot and pay the interest. So how much extra we paid? We paid extra the 2,500. This extra we will receive from the bank, because bank promised us the rate 2.6. okay, bank promised us 2.6. So bank will pay effectively. How much is our cost effectively? So how much we paid effectively? 16,000 we paid on how much? So we can calculate this. So effectively our rate is 2.6%. okay, so this is just for the explanation. You don't need to calculate like this, but in exam generally they ask you how much receipt or payment you have to do in case of forward rate agreement, if interest rate increase or decrease. okay, if spot rate. okay, so if this is spot, if spot is higher than forward rate agreement, if spot is higher than, then we will receive receipt. okay, we will receipt. okay, if spot is less than forward rate agreement. okay, if spot is less than forward rate agreement, it means we will pay, because here we have a loss, so we will receive from bank, but here we have a gain, so we will pay to the bank. okay, we receive from bank, but we will pay to the bank. So which one is the case? This is not the case in our exam. In this question, this is the case here. So spot rate is currently higher than the forward rate, which means we have a loss, and this loss will be compensated by the bank as paying to us how much? 2,500 we will receive from the bank. okay, so I hope you can understand this easily for my explanation, and don't worry too much. This is just, this one is our calculation in the exam. okay, so let's do next. Next is the interest rate guarantee. There is no numerical questions will be asked in the exam, but you need to just keep in mind this concept that interest rate guarantee is an option on FRA. okay, because FRA is set for the 3 months, after 3 months, but if we take interest rate guarantee, which means if in between 3 months we can take advantage of option. Interest rate guarantee is an option. It means we can take advantage between 3 months if there is an adverse movement in the interest rate. Okay, if there is favorable, then allow option to lapse. Okay, because we will go with the spot or we will go with the forward rate agreement. Okay, so okay, futures interest rate. Futures is a promise. Okay, future is a promise. Okay, so if you are a borrower, okay, if you are a borrower, what you will do, you sell the promise. Okay, you sell the futures. What you are selling, you're selling the promise to make interest. Okay, you're selling the promise to make interest. But if you are an investor, okay, if you are an investor, then you will buy the futures. Okay, so if you are a borrower right now, you are a borrower, so you will sell the future. Okay, you will sell the future and make the payment. But before the close, before the expiry date, we close out the position by reversing the original transaction by the borrower before the expiry date. It means that's previously sold them, then we buy the then we borrow deposit same amount. Okay, I will explain this actual transaction. This is the actual transaction. Okay, this is the futures. Remember guys, futures is the exchange traded. Okay, but forward rate agreement is the OTC. Exchange traded means the quantity, the lot size, or you can say the quantity, time, and the amount. The quantity, amount, and the time is already defined here, in exchange traded. But in case of over the counter, you can customize your contract, which means you can has the full amount in case of forward rate agreement. But in case of futures, you cannot has full amount. So this is the downside of this. Okay, but let's do this. I will explain this. The actual transaction is separate from the futures. If you are a borrower, which means you sell futures. Okay, you sell futures. Okay, but when you sell futures, you pay interest. But at the before closing, before the expiry, but before expiry date, what you will do, you will buy the future. Which means you receive the interest. Okay, so these cancel out each other, and you will only have to pay or receive the interest. So during this transaction, you will gain or lose. If you gain here in the actual transaction, you will lose. Okay, if you lose here in the actual transaction, you will gain. So this is the instrument just to hedge the risk, not to make the profit. Okay, remember. So this you have to remember for the exam. Okay, all the above explanation is just for the understanding. This you have to remember. Okay, if you are a borrower, you have to sell the futures. Okay, if you are a deposit, if you are an investor, or you are a depositor, you have to buy the futures. Okay, next is the option. Interest rate options. Options means the option holder has the right, not the obligation. Option holder has the right, not obligation. Okay, to own the interest agreed on a specified interest rate on or before expiry date. If the actual if the actual transaction, or I can say the spot rate is favorable, then we will lapse the option. But in case of adverse, we will, in case of spot is adverse, if sport is adverse, we we use option, if sport is favorable, we go with sport and lapse the option. So you don't have to execute the option, you have the right, not the obligation. Okay, so for this option, the seller of the seller who, the person who is selling this will charge a premium, so you have to pay the premium. Okay, you have to pay the premium if you are a option buyer. Okay, so let's understand what is call option and put option. Okay, put option means right to sell. Okay, right to sell, but call option means right to buy. An option to pay interest at a predetermined rate on a standard notional amount over a fixed period of time. Okay, so when you you when you I mean when you buy put option, if you are a borrower, you buy the put option. When you buy the call option, if you are a investor, or depositor, then you will buy the call option, right to buy. Okay, it means put means you are selling, you are putting on the table, or call means you are calling to your side, it means you are buying the option. Okay, remember this. So you don't need to remember everything and all these steps. This is just for the explanation. You don't need to worry about this. This is just for the explanation. Just remember this. In the exam, this is only the important. There is no numerical questions will be asked for this topic. Okay, so cap, floor and collar. The cap is useful for the borrower, because because cap will protect the borrower from rise in interest rate. Okay, this is like the cap. Okay, so if the interest rate cannot go beyond this. Okay, so interest rate cannot go beyond this, which means the cap is for the borrower, so it is protecting against rising in interest rate. Okay, so set a maximum interest rate for the borrower, and the floor is for the floor is for the floor is for the floor is for the investor. So investor floor is the, it protect against, set a minimum rate that is useful for the investor, so interest rate cannot fall beyond this level. If fall beyond this level, they can use the floor and take advantage of it. Okay, if you are a investor and borrower both, then you can use collar, which means simultaneously buying the cap and floor. Okay, which means you are protecting against the interest rate rise, also protecting against the interest rate decrease. So interest rate cannot go here and cannot go here. Okay, so interest rate collar is where options are set both maximum and minimum range, and over the cap, maximum rate paid, and seller collar between no benefit. Cap will be a premium and selling, save transaction cost. Okay, swap. Next is the swap. Interest rate swap. Okay, interest rate swap is used for the long-term hedging of the risk. Okay, if you want to hedge the risk for the long term, then you have to use swap. Okay, in this swap we cannot do by ourselves, but the intermediary who did this swap is generally the bank. Okay, the bank. So I will explain this by using this diagram, this table. Okay, so the one person is Mr. A and the another is Mr. B. Okay, so Mr. A can borrow the variable rate loan at LIBOR plus 3%, but fixed rate he can borrow at 12%. Okay, because of their credit history. Okay, but the Mr. B can borrow floating rate at LIBOR plus 2% and fixed at 15%. So he is getting fixed at high rate, but he is getting variable rate at high rate. So okay, and one another he is getting the fixed rate at very low rate and he is getting very low rate, but he wants this Mr. A wants to borrow at floating rate, but Mr. B wants to borrow at fixed rate. Okay, but this is not beneficial for them. Because if we consider this the aggregate loan we are paying aggregate amount LIBOR plus 18%. But if they borrow according to their good credit history, then he can get Mr. A can borrow at 12%, and Mr. B can borrow at LIBOR at variable rate at LIBOR plus 2%. So in aggregate, they are only paying LIBOR plus 14%, which means there is a saving of 4%. Okay, there is a saving of 4%. In this we use swapping method to swap the interest rate so that their desire can be fulfilled. Okay, their desire will be fulfilled by the swapping arrangement. This swap is done by the bank, and bank will charge generally, say, let's assume 0.5%. So only 3.5% is the benefit that has to be distributed between A and B. Okay, generally in the questions in AFM we have ratios like 2 ratio, like 1:4, or 3:4, or any ratio that is given in the question. This benefit will be distributed between A and B. An interest rate swap is an agreement whereby parties agree to swap floating stream of payment. There no exchange of principal. So it's one party having fixed rate actually desiring variable rate, and another party want fixed rate but 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 having variable rate. So okay, I already told you that because of their credit history they are getting different interest rate for floating and fixed, because Mr. A has benefit in fixed rate at because the bank is offering fixed rate at lower, but in case of B the fixed rate is very high. So but in case of Mr. A the variable rate is very high, but in case of B the variable rate is very low. So they borrow according to their benefit, according to their credit history, but 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 they don't want they don't want, because Mr. A don't want to borrow at fixed rate, so their desire is floating. So they will fulfill this desire by the swapping arrangement. Okay, in this swap, because we are doing this, because we are using our credit history to save the transaction. So overall we consider, if we overall we consider this, we are aggregating, we are paying LIBOR plus 14. But in case of, if we go against our credit history and fulfill our desire, then we have to pay 18% LIBOR. But by using the swap arrangement, we fulfill our desire and save our save this amount. Okay, I hope you guys understand this. Don't worry too much about this. You don't have to calculate anything in this. You just have to remember the concept, and you are very comfortable in the exam. Okay, next we will do the questions of this chapter, foreign currency and interest rate risk. Okay, and we will together solve. So that's all for now.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.